Hi, I'm Jimmy. In this video, we're looking at 3 of the more popular dividend ETFs. We're going to look at the basics of each ETF, what kind of companies are in them, and then how they performed versus each other. So the first dividend ETF is the Dividend Aristocrats ETF, ticker symbol NOBL. Then up next, we've got the Dividend Appreciation ETF, that is VIG, ticker symbol VIG. And then finally, we'll compare that to the Invesco S&P 500 High Dividend Low Volatility ETF, ticker symbol SPHD. Okay, so let's start with the basics. Let's start with their expense ratio. NOBL charges an annual fee of 35 basis points. VIG charges just 6 basis points, they're a Vanguard fund, and then SPHD charges 30 basis points. So clearly, out of those 3 dividend ETFs, VIG is looking the best since they charge the lowest fee. Now, just so we're on the same page, if we owned any one of these dividend ETFs, or really any ETF out there, we're not going to be charged these fees explicitly. I mean, we're not going to get a bill, or they're not going to take any money out of our account or anything like that. These fees get charged to the fund itself. So if the fund had $100 million in it, well, the fund manager simply takes their fee out of the money that's in the fund, probably on a quarterly basis. So with fees this low, it's unlikely that we would really notice the fee coming out. It would be very difficult for us to tell when it came out. Now, they're going to announce it in their prospectus, but we probably wouldn't know it. The way it would actually happen is if it's a $30 stock, well, you would just chop off a few pennies in value because the fund would be decreased by the fee. So that's how the fees work. Okay, now simple enough. Now, since these are dividend ETFs, let's look at some of their dividend details. So NOBL has a dividend yield of about 2.4%, and they pay their dividend quarterly. Then VIG pays a dividend of about 1.9%. They also pay theirs quarterly. And finally, SPHD has an impressive dividend yield of about 5.8%, and they pay their dividend monthly. So if we prefer monthly dividends, SPHD, they're off to a pretty good start. Okay, now this brings us to a quick analysis of how diversified each of these dividend ETFs truly are. NOBL has about 67 companies in that particular dividend ETF. And when we switch over to their sectors, well, we can see that they're fairly well diversified. Their largest sector exposure is in the industrial sector, which accounted for about a quarter of the fund. If we're curious, this piece of the fund has companies like 3M, Raytheon, Caterpillar. Now, because they have a decent amount of companies in the fund, no one company holds a huge piece of the overall fund. In fact, the largest holding in the ETF that I could find was Lowe's, and they accounted for a bit less than 2% of the overall fund. So this is a fairly well-diversified fund. Okay, now we shift over to VIG, and this is the Vanguard Dividend ETF. And once again, they look like they're fairly well spread out amongst different industries. The industrials are their largest segment as well, although that's only slightly larger than their information technology sector. VIG owns even more companies. They have more than 180 companies in this particular ETF spread out amongst all these different sectors. Now, we saw with NOBL that every company represented less than 2% of the overall portfolio. And that's because that particular dividend ETF was an equally weighted ETF. And that simply means that when the fund managers rebalance the fund, well, they make all the companies represent the same piece of the portfolio. So if there were 100 companies, well, each piece of the portfolio would get 1%. 50 companies, they'd all get 2%. Here they have 60 some odd companies, so they get slightly less than 2. Now, once the companies start trading freely, well, if the value of one company goes up and the others go down, you'll see a shift in the overall weights. But when they do their rebalance, they're equally weighting them. But with Vanguard's dividend ETF, well, they pick their weights based on the market cap. So the bigger the company is, the bigger the piece of the overall portfolio that company is going to represent. As an example, their largest company right now is Microsoft, and they represent about 6% of the ETF. Despite the fact that there are more companies in this ETF, their largest position is 3 times bigger than what NOBL has. Their second largest company is Walmart, and that represents about 4.5% of the total ETF. So those 2 companies alone represent more than 10% of this particular dividend ETF, even though, like I said, they have more than 180 companies in there. Now, this isn't necessarily a good thing or a bad thing. If their larger companies perform well, then this particular dividend ETF should perform even better. So Walmart, as an example, they're in both NOBL and VIG. In fact, they're also in SPHD, but we'll get to that one in a second. Either way, Walmart in VIG represents about 4.5%, and it only represents about 1.4% in both NOBL and SPHD. So if Walmart were up, let's say 5% today, well, that will affect VIG 3 times more than it will affect the other two ETFs, since its weight is 3 times larger in the VIG ETF. Okay, simple enough. Now let's move over to SPHD. Once again, this is a fairly well-diversified ETF when we look at their breakdown. Now, they have about 50 companies in this ETF, and their largest company is Williams, and their second is Iron Mountain. Both of them represent slightly more than 3%. Now, they determine the weight of their individual companies different than the other two dividend ETFs. Their weights are based on dividend yield and volatility. So in theory, they end up with a higher dividend yield and ideally lower volatility. Now, I was curious if they do in fact have lower volatility. And when I looked at their standard deviation over the past year, well, it seems that they actually have the highest of all 3 of these ETFs. Theirs was the highest. The lowest volatility was VIG, and they came in slightly better than NOBL. Okay, so now let's shift over to their performance. This is a chart of their total returns since 2013. Now, I only went back to 2013 because that's when NOBL first started trading. So 2013 in this chart represents a full year for VIG and SPHD, but only a partial year for NOBL. Then in 2014, SPHD performed the best, and SPHD held that lead in both 2015 and 2016. Now, I want to point out that these numbers are all total returns, and they do account for both fees and dividends paid. I also assumed that we reinvested any dividends that we would have received back into that ETF. Okay, so after a good couple of years for SPHD, well, then they had 4 straight years of underperformance. And we may notice that during that, I didn't really mention NOBL because they're the ones in the orange bars. And they were more consistently in the middle. They had 1 or 2 years where they were on the lower end, but the first year I didn't count, 2013, because again, that was only a partial year for them. So I'm sort of ignoring them. Besides that, they were okay compared to the 3 of them. And if we're curious, this is how each of these 3 dividend ETFs have performed since NOBL started trading back in 2013. So I went from that day and forward, how did they do? Clearly, VIG is doing the best. And this may not be a surprise based on some of the annual numbers that we looked at. Then NOB came in second, and third was SPHD. Now, I want to be careful of assuming that just because this is what it means today, that we don't assume that this is how it's going to shake out all the time. As an example, if we went up to just the end of 2019, ignoring the crash from the coronavirus, well, this is the way those numbers would have shaken out. And here we can see that NOBL performed better than the others. Now, once we got into the coronavirus crash, we can see that in 2020 year to date, on the chart here, well, we can see that NOBL had a bigger dip, so it lost some of the ground that would have had up to 2019. This is where that lower volatility really comes into play for VIG, which at the end of the day has done a little bit better. So now we may ask, where do each of these ETFs belong in our overall portfolio? Well, SPHD pays the best dividend. So clearly this could be very useful for us if we're looking to sort of live off those dividends, if we need that payout now, because it's consistently paying a higher dividend and it pays it monthly. And then with NOBL, well, they have more big companies, call it big blue chip companies in it. For example, Microsoft is not in NOBL since they haven't raised their dividends for 25 consecutive years. And therefore, they don't meet the requirements of NOBL. So to get into NOBL, you have to be more of a blue chip company than Microsoft. So clearly, we like the stability of all the companies in NOBL, but they miss out on some of the gains of a company like Microsoft, which, by the way, over this very same time period is up more than 700%, which would explain why, at least partially, NOBL underperformed some of the other companies during this time period. Now, if we like the stability of big blue chip companies, I think NOBL makes a lot of sense. But we can see that with this particular crash, VIG has held up the best. So personally, I actually think it makes sense to mix up the holdings of all 3. If I were going to own them, I would look to own all 3. If I had to pick just one, I would probably lean towards NOBL, but that's because I like bigger blue chip companies. Now, one question we may ask is, should we invest in dividend ETFs, or does it make sense in sticking with dividend stocks? Well, I actually did a video where I compared the benefits and drawbacks of both investing in dividend ETFs or dividend stocks. And then I give my opinion on which one's the best in what situations. If you're curious, that could be a good next video for you to watch. There's a link right here. There's a link in the description below. And thank you so much for sticking with me all the way into the video. I really appreciate it. Thanks, and I'll see you in the next video.